All right, folks. This is an unscheduled session today. Welcome. It is right now um, a little bit after 4:20 in the afternoon. Oh no, I'm sorry, 3:20 in the afternoon. Oops, 3:20 in the afternoon on Friday, July 29th, 2022. I'm just taking a look at some of our month-end data, like I like to do every day, every month. At the end of the month, I like to look at the long-term picture because that's where we find our edge, and that's where we can really look the big picture and not get tossed around by the short-term noise. Especially in this market, there's going to be a lot of short-term noise. So I think it's a good idea for us to take a look at the long-term picture. Okay. First things first, let's take a look at what the indices are doing right now. This is our weekly indices chart. As you can see, we're still in a weekly downtrend. All right. If we look at the monthly, it looks like this month we're recovering almost all the losses from last month. Okay. So technically, we're closing flat now for the last 3 months. Okay. And so that's the big picture. If we look at more of the weekly chart, we're still in a weekly chart downtrend. Okay. I'll explain to you what this line is later on, but let's look at the big picture first. All right. So that's what it looks like. All right. If we take a look at the S&P 500 priced in euros, if we look at the long-term chart on that, let's say we look at the monthly, it looks very different, doesn't it, when we look at it in the perspective of denominated in euros. And why do we denominate it in euros? Well, first of all, a third of the SPY, or the index, well, not just SPY, but there's several index ETFs that track S&P 500. About a third of them happen in euro denominations. European investors, also Middle Eastern investors, they when they invest in the S&P 500, they actually see it in euros. Okay. And so if you actually look at this, we're actually almost back to all-time highs when you look at S&P 500 priced in euros. If you look at a NASDAQ priced in euros, a little bit still ways off. All right. But S&P 500 almost there. Okay. So this is what could happen if the dollar really drops. If the dollar drops just from the currency conversion, we could see, we could definitely see this coming up. All right. Now, will it actually go up to the same levels as our euro chart, like right here? Will it go there? Will it go all the way here to 4,500? It's possible. It's within the realm of possibilities. I think we're going to see a little bit of a pullback before we get there. I could be wrong, though, but that's definitely suggestive. That's definitely what we see, though, if the dollar drops heavily. Okay. Speaking of the dollar, let's go ahead and take a look at the dollar anyway. This is the dollar futures right now. This is the weekly chart. Let's look at the monthly chart. As you can see in the monthly chart, and if we zoom out, all right, it tried to make a new high here. It tried to make a new high here, and it kind of looked like a triple top at first, but then it broke out of that, and now I think it's coming back just to retest those levels. Okay, will it come down here? I'm not sure myself. About a week or so ago, was it a week ago? No, it was maybe a couple days ago. I said that it's very likely that the dollar made a top for this season. I do still believe that the dollar will make new highs. Maybe not all-time highs, but it will definitely go beyond the July highs of this year. I think sometime next year or the year after. Okay, these currencies don't move in straight lines for that long period of time. Okay, the currencies tend to make these longer moves, and that's why I always like to take a look at the weekly and monthly charts, because then you can really see what's going on. Here, even when the dollar goes up here in the 90s into 2000, when we had all that IMF crisis, the Asia financial crisis, and then the dot-com bubble here, as you can see, even though it rallies, there are weeks, months even, where it retraces, comes back, retraces, and comes back, like here. Like this took like 2 years after its initial run-up. It took 2 years to make, to get out of this consolidation zone. Okay, so these moves generally are multi-year moves. All right, same thing with here. I think this is the beginning of a multi-year move higher, but we may consolidate for a little bit. Okay, again, maybe about 2 years, maybe 1 year. Who knows? Nobody has a crystal ball to this, but definitely, I do think that for this year at least, this is probably going to be the highs. Now, is it very possible that we retrace a little bit and come back just to retest it? I think it's very possible. Very possible. All right. And one of the indicators that I want to look at today is ZF. It's the 5-year Treasury note. Okay. I've introduced this as a indicator a few weeks ago, actually, a couple weeks ago. This was one of our 4 indicators that we were looking at. We were looking at the dollar. We were looking at the euro. We were looking at this and our junk bonds advanced decline line. Remember those 4? So this was one of our 4. All right. And if this breaks out, okay, if we have a breakout in this ZF, I think it's a very good chance that the dollar actually will come down, because if this goes up, that means shorter term yields are coming down. Remember, folks, bond prices and bond yields are inverse of one another. Okay, so as bond prices go up, bond yields come down. So if the shorter term, this is a 5-year Treasury note future, so if the 5-year Treasury note starts rallying, that means shorter term rates are dropping, which actually steepens the yield curve. Okay, when that yield curve steepens, all right, cash will become trash again. Okay, nobody will want to keep cash. Okay. What they will end up doing is buying whatever assets that they can. All right. If this goes up, now, if this actually breaks down, then no, the yield curve will further invert, and then we'll probably have some volatility and risk off sentiment again. Okay. One thing that I mentioned on the Discord that I just wanted to go over too was that in recent days, it's come out that there has been a record buildup in certificates of deposits here in the United States. CDs, certificates of deposits. What are they for those of us that are not in the United States? So certificate of deposits are bank deposits where they give you a little bit higher interest than, let's say, a normal savings account or a normal or what they call a current account, I believe, in Europe. But they give you a little bit more interest, but it's held for a certain amount of time. Let's say a 6-month CD, you're agreeing with a bank to hold that deposit for at least 6 months. They give you a little bit of higher interest for that, okay? And if you break the terms of the CD, there's usually a penalty. Every bank's got a different penalty. Some banks will just take away the interest that has accrued so far. Some banks have a flat fee, whatever, but generally, people hold it until maturity. They're 6-month, 1 year, 2 year, 3 year CDs. So remember a couple of weeks ago, I told you that retail was selling. Remember, retail clients were selling and institutional investors were buying at a record rate. All right, right here. Okay, which is very characteristic of retail and the start of the bottoming process in the market. Okay, the weak hands have capitulated and the strong hands gobbled it all up. So what is now retail doing with their money that they got from being weak hands? They're putting it into certificates of deposits, which means it makes money market funds absolutely, it makes it worse to be in money markets. Okay, again, cash becomes trash. Okay, cash becomes trash because at the bank, whenever there's a certificate of deposit, the Federal Reserve requires the bank to hold an asset against that certificate of deposit or those deposits. Okay, they make them hold an asset against it. So since record amount of money is going into certificate of deposits, guess what? These funds had to do? Guess what all these banks had to do? All these banks had to buy treasuries. So there is a treasury shortage right now, a treasury shortage. That's why we've seen recently TNX take a tumble, a hard tumble too. And that's where I found out about this. I was like, why are rates coming down so quickly, especially 10-year bonds? Okay, why is it coming down so quickly? And so that led me to find that, there's a lot of CDs that were being bought. And so a lot of the banks had to, post an asset against it and had to buy more treasuries. And so we're seeing a little bit of a treasury shortage right now. All right. There's just a record amount of cash sitting around. And again, there's a lot from retail. They sold all their stocks. They sold all their risk assets. And now they're sitting in CDs. So there you go. So I think the ZF, the 5-year futures, 5-year treasury note futures, I think this is going to be a really telling sign of short-term volatility. Again, if we start seeing this break down, I think we're going to see a little bit of a risk on. And I wouldn't be surprised if some of that happens, especially, or if it even happens, okay? If this even are gonna, I don't know. No one can predict the future, right? I'm just anticipating what could be just in case if it does happen. But if this comes down, I wouldn't be surprised, okay? I wouldn't be surprised if it corresponds to our higher levels here where we saw the hedging demand. Maybe we see hedging demand enter as this breaks down, okay? As the ZF breaks down. So again, if you haven't been tracking this before, start tracking it now. I think this is going to be very telling. Again, if this goes up, cash becomes trash, rally continues, that's it, okay? If this goes up, the dollar will come down, okay? The demand to hold all those dollars will just evaporate, eviscerate, okay? But if it breaks down, then we can see a dash for cash again. Dollar will go up and probably will have a risk-off sentiment, all right? We shall see. All right, we will see. But already, we're seeing signs here. It was breaking out and then it's coming back. I don't know if this is a retest or if this is a pause before it comes down. Nobody knows. So don't be placing big bets right now because right now I think capital preservation is key. Okay, capital preservation is key. Keep your positions super super small. All right. I see people typing on Discord. Absolutely fumbled the bag today. Got wrecked. Well, I warned you guys. Keep your position small. You gotta pay attention to this stuff. Okay, you gotta pay attention to this, especially if you guys are active. All right. I don't like being active. My philosophy on being active. Okay, and this market actually proves kind of my point. I believe, in my opinion. Okay, everybody's different. I know some of you like to stay active. Some of you do very well staying active. Me, I just don't. I think the point here is to make as much money as possible from trading without having to sit in front of your screen and mashing buttons all day. Okay, that's the point. And so that's why I'm not a big fan of day trading or zero DTE trading. That's just not my style. Again, it's because you got to be. It's like sitting in front of your computer screen getting abused all day. That's just not. That doesn't bode well for me. Okay, so. Money, if you lose money, you can always make it back, right? But time is, I would say, one of the most valuable commodities out there is time, okay? It's just the sheer amount of time you got to spend on day trading. And not only that, if you're day trading, that means you're taking a lot of risks, short-term risks. So that means you have to keep your position small. So you don't even make that much money anyway, okay? I know some of you are out there making, some of you are claiming, oh, but I can make big bucks. Well, try that for 5 or 10 years and let's see what happens, okay? Can you do that for 10, 20, 30 years? All right, so let's be real about that, And again, this business is a marathon. It's not a sprint. All right, it's a marathon. So, again, it's about planning ahead, not really reacting to the market day by day as tick by tick, but making plans outside of market hours, executing our plan, and being able to just walk away from our system and know what our risks are. That I think is the way to go. And plus swing trades, those multi-month, multi-week trends, that's where all the money is anyway, okay? In my opinion, at least. All right. So again, guys, take a look at this. ZF, that is going to be one of our indicators that we track from now on. On the monthly chart, though, it does look like it came to its low here. It's 2018 low, and it kind of bounced from there. Is this just a dead cat bounce, and do we come down? Not sure. This is why, it gives us a little bit more clarity, the monthly charts. Again, today is the end of the month. We're looking at these monthly charts. This is the 30 and 10. Okay, this is the 30 and 10. On the daily chart, it does look like it's breaking out, does it not? It kind of looks like it is, isn't it? But if we look at it from a little bit of a higher bird's eye perspective, the main trend is still down. I mean, it could very well, this could be a trend reversal. I don't know. It's hard to say. Okay, it's hard to say. If it keeps going up, though, that means that the stagflation fear is over. Okay, and generally when we see this break out like this, the 10 and 2 year will also start breaking out. We haven't seen that yet. It actually got more inverted. If you look at the monthly chart, that actually looks terrible, doesn't it? Okay, it's back to its 2007 lows. Look at that. Oof, 2007 lows. Okay, could it go lower? It could. And as long as this goes down, that's headwind for the banks. All right. Now, if it turns, if the 10 and 2 start following what the 30 and 10 are doing, and again, the 10 and 2, if you look back throughout history, whenever the 30 and 10 goes up like this and starts breaking out, usually the 10 and 2 follows within a week and a half, maybe up to 2 weeks later. So who knows? Maybe in a week or two, will this start going up? That that would be a confirmation of this of the stagflation fears going away in the markets. Okay, but we haven't seen that yet. Until we get that confirmation, until I see it, I'm not gonna believe it. I'm gonna believe it when I see it. Okay, but on the monthly chart, oof, it looks bad. It looks really bad. Okay. Oh, this is also interesting. So, I mean, it's got still a ways to go, but it's close to its all-time lows since the 80s. A little bit more. It needs maybe about a month or so more if it were to drop more. If. That's a big if. Nobody knows. Okay? So that's what I see. Let's also take a look at HYG, junk bonds. Okay? Junk bonds. As you can see, junk bond generally HYG is not a good. It's not very good to look at on a higher time scale because of the fees and the drift and the dividends that get paid every month. So for HYG, we'll keep it to the daily chart. But I also wouldn't be surprised again if we get to our higher levels where we wanted to buy puts on the S&P 500. I wouldn't be surprised if that also corresponds to this level here. Actually, I have some levels already pre-drawn on my Thinkorswim platform. If we look at the daily chart on this, I think it's very possible that this goes up to here, and that's where we see the markets possibly reverse. Again, I think that the Fed might come out with something hawkish if this gets up to here, because again, what this measures, if HYG junk bonds ETF goes up, it just means that zombie companies and companies that are not productive are able to get cheap credit from the bond market again, and that's probably not what the Fed wants. Okay, that would reverse all the hard work that the Fed has done already. Okay, so I don't think they're gonna let this continue go above this. Okay, call it the Fed call it whatever you want, but I think there's a very good chance it gets talked down from here. Same thing actually happened right here. It was actually a weekend. This weekend, I don't know if you guys remember this weekend, but it was around this weekend where a lot of the Fed governors came out and started getting really hawkish. I think we talked about this on the first High Noon Highlights, one of our first episodes. We started in the end of May, early June, and we talked about this in one of our first episodes about the messaging of the Fed around this week. I wouldn't be surprised if we see something like that here, because I think they track this. I think the Fed is definitely tracking this. Okay. So something to think about, okay? I think it's very possible, all right? One other thing that I wanted to go over as an indicator too, something that I mention every once in a while, it's our corporate bond spread. So it takes the junk bond yield and subtracts the 10-year treasury yield against it, okay? So what does that really show you? That shows you how much of a risk premium there is on corporate bonds above quote unquote risk-free rate. You know, in finance, in institutional finance, the 10-year treasury rate is considered the risk-free rate. Okay, it's a rate that you can make risk-free. All right, that doesn't mean buying treasuries is risk-free. By no means. It just means it's just an arbitrary number that they use for comparison of risk assets. Okay, so they use the 10-year treasury bond as a risk-free. So the more yield that bonds have over the 10-year treasury, that just means there's that much more risk, right? You need more reward if you're going to take more risks, right? So the bigger this gets, that means the more risk, the more perceived risk there is in corporate bonds, okay? So if this is going up, that means that there's more and more perceived risk in corporate bonds. If it's going down, that means there's less and less risk, okay? Generally, in very stable economic growth environments, we have downtrends in that line. If you actually take a look further out of view, you know, good economies, good stable economies, you know, we see downtrends, right? Usually in recessions, that's when we see spikes in this, okay? Recessions are bad times, slowing economy, okay? More risk, more perceived risk in corporate bonds, all right? So, actually, I'm curious, how far does this go back? It only goes back to 86. What a shame. What a shame. I wish I could see the 70s. Oh, well, it is what it is. Okay. So, here, as you can see, the corporate bond spread is making higher highs and higher lows. Well, this wasn't a higher high, but this was. It made higher lows, okay? I don't know if this is maybe a low. If it keeps going up from here and makes another higher high, definitely that's supportive of a case where we might see one more leg down. And I think so. I think we do see one more leg down in this market this year before we start our uptrend, okay? I do still think we have one more, all right? So we shall see. We shall see what happens, okay? Also, too, I am going to revise our index plan, okay, for SPY. Actually, let me put up the SPX chart, okay? This is the S&P 500 cash index. All right, let's take a look at the weekly chart. My buying program is not going to change, okay? I'm still going to buy when it gets to this line right here, like 3,600. If we revisit the lows, I'm going to buy SPY right there. I'm still going to buy SPY some more if it gets to our 3,400 zone. And if it gets under 3,400, I'm still going to buy those in the money SPY calls. That has not changed. That part has not changed. What has changed, though, is when am I going to start buying puts? Okay, when am I going to start buying puts? Now, you know, we went back and forth on this, like, ooh, should we start buying at 4,150? Should we start buying it at 4,300? And I kept going back and forth, back and forth, back and forth. Okay, I think, you know, from just what I see and just from the possibilities here, you know, what I did was I just drew some lines here. This was when we first started seeing initial hedging at the top right here in January. We actually saw a lot of initial hedging happening here, and we actually saw a dash for cash and hedging also happening right here. So I connected those two lines and I just brought it down, and that gives us our weekly trend line, okay? I am going to start buying puts 3 to 6 months out right here. Actually, I'm actually thinking about buying it a little bit closer on the closer end. Instead of the 6 month mark, I'm actually thinking more 3 month mark. Okay, closer to the 3 month. Again, it just depends on the skew, and I'll make that decision at the time. But just based on skew right now, it just looks like as if the closer dated months are probably going to be better. So I'm going to be looking at maybe September or October puts. Okay, put spreads, debit spreads. Okay, verticals. And I think I'm going to start buying at this trend line right here, which is around 4,200. Okay, it's around 4,200. All right, so I'm going to start right there. All right, When am I gonna exit? If it starts, if it starts breaching 4,300, or if we get 2 weekly closes over this line, I'm out. Okay, so at the most, I'm probably gonna hold it for 2 or 3 weeks if I'm wrong. All right, so that is my new plan. I'm going to start buying puts at this red line right here. And again, if we start closing over 4,300, or if we do about, let's say two or three closes over this red line, then I'm out. Okay, because it hasn't closed over that line since since we drew it, or since it's been drawn since January. Okay, so it hasn't really closed over this line. I think that's a good point. It's just a good risk management tool. Okay, I'm just using this line as a risk management tool. All right, I'm gonna start buying puts here. If it gets over, then we get out. Very minimal loss. Okay, so that is the update to my plan. And again, that just comes from the weekly and monthly, looking at things from a little bit further out view. I do think we hit that and maybe we come back down. Okay, very possible. All right. So again, my plan has changed. Everything else, my plan has stayed the same. For all other tickers and everything else, it's still the same. Okay. Everything else has stayed the same. It's just this. It's just the U.S. indices. Okay. When I start buying puts, that's the only thing that has changed, guys. Okay. So keep that in mind. All right. I just wanted to give you guys that update. That's the bird eye view. Let's just take a look at some of our other plans. HUT. Look at that monthly. This is the monthly chart. It looks like it found a little bit of support at its old base here, the 2019-2020 base, and it's just bouncing. Could this be a dead cat bounce, or could it retest that? I hope so, because that's where I want to buy. I hope so. Ford running away from us per usual. Since I'm not in, of course it has to run away, right? For those of you who believe in candlestick analysis, this actually looks like an outside day up on the monthly chart, which is supremely bullish signal, long-term bullish signal. That doesn't mean though we don't retest. I mean, we could have a monthly candle that has a wick down, right? I hope it does, because that's where I want to buy some calls and I want to buy some shares of this. All right. But we shall see. PPC still at, look at that. I know PPC is having, it's consolidating, it's coming back down a little bit, which is good for us because we have a buy level in the 29s. So it's approaching. It's definitely approaching. So we shall see. But on the monthly chart, again, today is the end of the month. We're looking at monthlies today. The monthlies, it looks like it could visit that again. Hopefully revisits the monthly lows for July. And when it does, I think it goes up. Again, I'm pretty bullish on the price of chicken because the price of beef has gone up so much. Okay. All right. Okay, so let's take a look at some of our other stuff. Let's see here. Let's take a look at our crypto stuff. Crypto has been very interesting price moves. Actually, I want to take a look at Deribit first. Let's take a look at Deribit, and then we can look at the long-term charts. Let me pull up my Deribit stuff. I just had it. Where did it go? Right here. Okay. There we go. All right, let's take a look. Wow, look at that, guys. Look at the notional value of ETH. Remember how it was at... well, it went back down. Okay, so it was okay. Remember how it went from, it said 6. I guess when I hit the update button, it refreshed. But okay, so we're seeing some action in ETH and Bitcoin options. Bitcoin option notional value went way down. Now ETH has a very commanding lead in notional value when it comes to its open interest and options. Interesting, very interesting indeed. Okay, so where are most of our strikes? Where's the volume at? We're actually seeing a lot of volume in August 5th. Interesting. August 5th, September 30th, December 30th. Still a lot into September and December. Still, we're seeing the 3,000 calls. This 3,000 call comes up often, doesn't it? We see this often. We're seeing that very, very often. Let's see. Puts got bought versus sold. Let's actually take a look at here and see the let's see some other data here. What's going on with Deribit today? Deribit's been kind of like this last few days. This portion, the options portion, and the market data portion hasn't been really up. I don't know what's going on. It just worked like a couple minutes ago, or before I started the video at least. Deribit, they need to get there. Maybe it's because of the more interest. Maybe there's more and more interest, so people are flooding their website. It could be. Okay, so I'll take a look at the block trades later on and see where the block trades were, but let's just take a look. I mean, you're seeing just a huge amount of interest in December. You know, it's kind of like, again, I've been saying this, it's kind of like SPX, right? Seeing lots of interest in this. Wow, look at that, 10,000. We're getting into the 5 digits now. We're getting into the 5 digits in volume now. That's crazy. So there's obviously a lot of open interest here. A lot of open interest on 3,000. Look at that. Look at this. It's crazy. We're also seeing, remember guys, we also saw a lot in July 30th, which is tomorrow. So yeah, we're seeing a lot of interest here too. It looks like all the way up to 1,800. We got our big OI at 1,800. We got our big OI here at 1,700. So perhaps ETH has a little bit of a gamma hedge between 17 and 1,800. Very possible, especially since we saw all that volume coming in on the July 30th contract. So all that volume in the July 30th contract, I wish I could see the strikes. And again, if this if this part started working, we would be able to check and see. But you know, dang, I wish we could check that. I wish we could. But most likely, you know, what it probably is a lot of gamma hedging going on between 17 and 1,800. That's why we're seeing that gamma pin happening here. Could be. I noticed that today ETH was just kind of bouncing around this 100, 150 point range today. So that could be the explanation why. Again, I wish I could check, but this part is not working right now. The IT department there needs to get an upgrade. Okay, so there's that. August 5th, we're seeing a lot of action here too. I know, what is it? Our in-house crypto expert, MSC, told us that there's going to be a Gorley update or a call around this time. So maybe that's what they're hedging for, or maybe that's what they're speculating on. Who knows, right? Again, I wish this worked. Then we could see the block trades and see where things are going. But it looks like here we're seeing a lot of volume for the 1,900 calls for puts. You know, it's all over the place. But our big OI is on between. So on puts is pretty much, I mean, we got high OI all over the place, all the way down to 12,000. Or I'm sorry, 1,200. Here we're seeing big OI all the way up to 1,900. All right. I don't know if this is call sold or if this is bought, but again, I'll check that over the weekend and give you guys an update once the Deribit site is working. But that's a pretty big range, but I can definitely see for next week, you know, if the order flow doesn't really change all that much, we could be bouncing around certain levels. And just from an initial look, it looks like perhaps perhaps 1,600, perhaps there. Maybe it bounces around between 17 and 1,800, something like that. Maybe 16 and 1,800. It could next week just bounce around 16 and 1,800. Okay. Again, as long as the new order flow doesn't knock it out of this, it's very possible. I mean, those are some big OIs. Okay. So I can see that. I can see us bouncing around 16 and 1,800 for a bit. Okay, so that's just what I see just from the options data. That's just from the options data. Okay, now options is just one data point. Let's take a look at some of the other things. Bitcoin to gold. Again, today's the monthly. Today is our big bird's eye view of things. Even though we're looking at bird's eye view, I got to show you this. Look at this, guys. We made a lower high. It looks like, well, if this continues, if this actually goes up on, next few days, then, then it will make a higher high. But if this starts curling down, actually earlier today, is it actually going to close down today? Close is 1355. 1358. Okay, so we'll see. We are right there. We are right in the middle of things. Okay, so we'll see. We'll see if it closes lower or if it closes higher than this on the daily. On the weekly, this is what it looks like. All right. And on the monthly, this is what it looks like. So again, if you look at it on a monthly chart, we don't know yet if this is going to be a V reversal on the monthly or if it's just a dead cat bounce. I'm really hoping it is a dead cat bounce on the monthly because I'd really love to scale in at this red line. Okay, same thing with ETH. ETH recovered more of its losses last week compared to gold than Bitcoin did. And again, I just cannot resist looking at this. If you just look at the ETH chart on its own, it broke out of this level. It retested it today, actually. Interesting. All right. And then it's up. Okay, so I know I posted this chart earlier in the week, risk management, responsible risk management says that you all should have stopped out of this if you went short on this line. Even though there's a, I find when I have a stop loss, it tends to be about 30% of the time we would have been better off just holding. But again, it's for that 70%, right? It's for that 70% time where no, it can continue. You can continue being more wrong and even more wrong, right? So, I get it. It sucks that it could curl down, but responsible risk management says that if you shorted at this line, you should have stopped out by now. Okay, maybe we wait for here. Maybe this line corresponds with our SPX, our new SPX buying put level. Here, that would be crazy if all those things kind of lined up. HYG goes up to that line where, where the Fed talked it down and indices touch this line at the same time. Our ETH also touches this line. That would be kind of crazy if it all happened at the same time. That would be. Not trying to make predictions, but I'm just saying that it would be too far from a coincidence, though. It would just, I don't think that would be a coincidence if that happened, though. My thoughts on that. I think all of this is all tied together. Risk assets are tied together. Even ETH and Bitcoin. I think ETH and Bitcoin are becoming real asset classes, like institutional participated asset classes. It's not a fringe asset like it used to be. Now, when we talk about macro, when we talk about U.S. indices, when we talk about commodities, bonds, currencies, real estate, in that same breath, we also have to now talk about cryptos. I think so. I think it's here to stay. And it's all linked together now. So that's something to look at. Oh, our high-low, our new highs versus new lows. Let's see where it ends today. We got about 1 minute left or 30 seconds left until closing. So we'll see what happens here. But that line has been curling up ever so slightly. Look at that. It's starting to curl. And if it ends positive, if this number here ends positive today, this will start curling up. Now, it will not even be above its first moving average yet, okay? Again, the clearer signal is if it goes over all of its moving averages and on the next pullback, it makes a higher low. That is the mother of all buy the dips, the Moab. That's the Moab right there, okay? The mother of all buy the dips, okay? We're waiting on that. That's our big move. Again, guys, I've been telling you guys to preserve your capital because we're going to have that moment, I think. It's going to happen sooner than later. Okay, so you guys want to really have as much capital as possible to get that Moab trade, the mother of all buy the dips. Okay, again, I'm not predicting that that's going to happen. I'm just anticipating what could be. Okay, it could happen, and if it does, you're going to want that dry powder in your account. Okay. So stay small and, stay nimble. Stay small, stay nimble, manage your risk, okay? If you see a green position start going red, cut it, okay? It is what it is. I know it sucks, but cut it, okay? You really don't want to face large drawdowns during these times, okay? When things are a little bit less certain, okay? But although I will say certainty is going up, it's starting to look like we're the bottom is near, the bottom is close. Okay, that doesn't mean we can't undercut the bottom for a little bit. That 3,600 level or so in the S&P 500. It doesn't mean we can't undercut it just like a little bit. Maybe we have a little wick down or something. It's very possible. Okay, but we're close. I think we're maybe like a few weeks, maybe a couple months away from a mini bull market. Okay. That bull market could probably last about 6 months to a year. All right. If you look back into the 70s, all right. Oh, we're in a monthly chart, so it's not that hard to get back into the 70s. If you look in the 70s, inflation actually started around 69 or so. Okay. And then look at this. We had a mini bull market for what, 2 or 3 years? And then inflation came back. It came back harder on this one because this is when we had the Yom Kippur Wars and then the Arab OPEC countries, they turned off the oil spigot to the United States. And we saw that this was round 2 of inflation. Okay. And then, we made another mini bull market rally. And then we had bear ears. Here, look at this. Now another bear market, not as bad as before. Another bull market, another bear market, and that was our last one. That was our last kind of bear market. And Volcker came around here, okay. And after Volcker, so this could have been just a consolidation, but as you can see here, when Volcker joined, that was it. That was over, and he actually didn't stop raising rates until around here or so, okay, around here. So people were buying the rumor, basically looking forward to the fact that the Fed was stomping out inflation. Then it cooled off, and then we started a huge bear market trend. And again, this is actually where we saw the rolling bull market, low volatility, low correlation bull market. We call this a rolling bull market. And we actually saw one, last time we saw one was back in 2017. I think that for most of 2023, we're going to see that rolling, low correlated bull market. And I think these are the easiest markets to trade. These are the markets where we can really day trade because everything is so stable. Okay. Everything is so stable. The data is pointing toward that's what it's going to look like in the future. Okay. It's just rolling bull market, low correlation, rolling bull market. All right. Right here. We saw that here. Low correlation, rolling bull market. Okay, low correlation, rolling. That may have been. That one I'm not sure of. This one I'll have to look back and see. I know in 2017 for fact that was easy. I was trading this. I wasn't around in the 70s, but I was definitely around for this. Easy day trading markets, very easy day trading markets. And again, we're gonna pivot. We're gonna pivot from swing trades to day trades. On S&P 500 and U.S. indices when this happens, okay? So we tactically shift based on what the market gives us, okay? All right, we're tactical, all right? We're strategic about things. That's why we call ourselves checkmate trading, all right? We're trying to checkmate the market, okay? So that's what I see. I just wanted to give that update. This is, again, monthly. We're looking at monthly charts today. What about energy? Oof, look at that. Okay. Again, we call the top in oil, seasonal top. Okay. I think if the dollar drops, we could get back to like 118, 120 or so. We could, that will be the mother of all shorts. Okay. That's the mother of all shorts right there. Okay. Again, my plan is, here we short. Okay. Will it get there? Hopefully. If not, oh well. Okay. I do think though oil will make a new high maybe next year or the year after. I do think commodities will come back, like the dollar. The dollar will come back too, okay, because of inflation fears coming back, I think, for 2024, 2023. But for this season, I think this is the high in dollar. Okay, let's just take a look at the monthly. Yeah. That's what it looks like on the monthly. That looks kind of crazy, doesn't it? And that's a huge monthly wick. We might see a break. If it breaks here like that, that again would be such a bullish signal in the market if it breaks this green line right here. This pretty much tells us that, oh my goodness, like the uptrend is over in the dollar, at least temporarily. Okay, this is when everything changes. If the dollar breaks this, it all changes. Okay, so we'll keep an eye on that. All right. Any questions, comments, rude remarks? Today, yeah, we'll call that a day. Okay. I'll post this video on our Twitch. I'll post this video on our wiretap tapes. I will keep our Twitch on over the weekends. I do stream Bitcoin and Ethereum data, so I'll do that again this weekend. If you're joining us from YouTube and Twitch, join our Discord. We have conversations like this on a daily basis, around the clock. And for those of you who are on our Discord, also, check out our Twitch and YouTube pages. You can always look back at all of our recordings to see what our plan is and what our thoughts are and indicators are. Today is Friday, end of day. I hope you guys have a wonderful weekend. Step away from your screens, spend time with your families, really enjoy the summer. If you guys are in the southern hemisphere, I guess this is your winter. So I guess for you guys, try to stay warm. But it's been a pleasure, guys. What a week. We'll do this again next week, and be on the lookout for our next call.